My name again is Justin Kribs with InsMed Loan Advisory Services. I will be your volunteer presenter tonight for Financial Beginnings presentation, or I should say a modified Financial Beginnings presentation. I've added and changed a few slides on credit and debt. I'm joined by Joanne, who is the area coordinator for California. Like many of you, I am working from home, so broadcasting from my youngest daughter's bedroom. So if we get a visitor, I apologize. Hopefully it won't be too long of an interruption. If it is, then we'll just kind of pick back up where we started. So get going on this. We're going to be going over essentially the basics of credit and debt. Yeah, we'll cover some aspects of student loans, the CARES Act, as you see up there. We'll be going over, credit scores, what affects a credit score, how to build credit, idea about leverage, and a case study involving two MD PhDs that I worked with a few years ago when I was at OHSU. So getting started, the CARES Act. The reason why I'm bringing up the CARES Act during this presentation is the fact that it directly impacts anyone who has ever borrowed for student, who has borrowed for medical school or dental school, or really anything. If you've taken out federal loans, the CARES Act directly impacts you. CARES Act also directly impacts businesses. You have businesses that are able to take out forgivable loans to help pay for things such as payroll. And I have plenty of people that I know that, their clinics shut down during COVID-19, and they needed to rely on some of these loans in order to keep operations going. So CARES Act, as it pertains to federal student loans, for those of you who are borrowers, you will notice that your loans, at least the covered loans, the interest rates should have gone to zero. And that's one of the provisions of the CARES Act. This goes back to March 13th when President Trump came out and said, hey, if you have a federal student loan, we're going to set your interest rates to zero. Then the Department of Education came out and said, hey, we're going to let people pause payments. And then the CARES Act came out and says, we're going to force people to pause payments. And so there's three main provisions for student loan borrowers as it pertains to the CARES Act. And you have to keep these provisions in mind, especially since these provisions come to an end in September. So they have the postponement of payments, postponement of interest, and the consideration of payments. So what they're saying is that if you have a federal direct loan, if you have borrowed a federal direct loan, or if you have federally managed FFEL loans, then you do not have to make any payments until October. As simple as that. Now, if you have loans that are not covered by the CARES Act that are federal loans, you can consolidate those loans and make them eligible for the CARES Act provisions. It's just with consolidation, it's one of those things that you want to make sure you take a hard look at what you've done, because whenever you consolidate, you're essentially erasing whatever you've done in the past. So let's say that you're working towards public service loan forgiveness and you consolidate your loans to try and make all of your loans eligible for the CARES Act. Well, when you consolidate, you start over from scratch. So if you're in year 3 of training and you have made 30 to 36 payments towards public service loan forgiveness, and then you hear about the CARES Act, you think you have to consolidate to be eligible for the CARES Act, you consolidate, well, you start from zero. The 36 payments you had made in the past count for nothing. So whenever you consolidate, you start over. But the CARES Act, again, you shouldn't be making any payments. Now, we're going to lead up to how this is also important when it comes down to credit. Second provision, no accrual of interest, as simple as it sounds. Everyone's interest should be at zero. So if you pop on to Nelnet, Great Lakes, Mohila, Ed Financial, Navient, any of the federal loan servicer organizations that are out there, MyFedLoan, you should see that your interest rates on your loans are at 0%. Everything. If it's federally held, federally managed, it's zero. So one thing to note, of course, is that this does not apply to private loans. If you have refinanced your loans, it's not covered by the CARES Act. In fact, private loans are not part of any of the future legislation that's coming out, simply because as they look at trying to balance budgets with, future like the HEROES Act, the CARES Act, extensions, etc., Private loans are not something that they think about. So of course, a private loan would be if you started residency, you thought, hey, I don't like my federal loans at 6% interest rates. I want to go for a 3% interest rate that was offered to me from, I don't know, SoFi, Laurel Road, Evervest, Link Capital, any of these corporations that refinance student loans. Well, as soon as you moved your loans away from the federal umbrella to a private umbrella, you're no longer eligible for anything having to do with the CARES Act. And so that might be, I've had people come to me and say, well, Justin, I'm still making payments on my loans. All right, well, that's because they're private. This is only for federal. So no accrual of interest, 0%. You have 0% loans until October if they don't extend it. Consideration of payments. This was important because they're automatically turning off the payments for federal loans. And what was happening is that people, because they were being forced to stop their payments, they were afraid that they were losing credit for public service loan forgiveness. So remember, one of the provisions or one of the things you have to do to get forgiveness is you actually have to be making payments. Well, if the government is telling you you can't make a payment, then you just miss 6 months of payments. And those 6 months of payments during, for instance, training, residency or fellowship, those are your smaller payments. Well, you would have to make up for those payments later on as an attending at a higher salary, which means your payments are bigger. What the government came out and said was, hey, as long as you're still working full time, as long as you still have eligible loans, you're meeting all the other criteria, we're not going to count missed payments against you. In fact, we're going to say that you actually made payments, even though you didn't. So as long as you're working, no one missed a payment for public service loan forgiveness. So consideration of interest, consideration of payments, and then also no payments. Now, something that's come up about this is that, of course, federal loans, they directly impact your credit score. I mean, every loan on your credit report impacts your credit score. And your credit score being that number that determines essentially your cost of life, your cost of living is all determined from your credit score. We'll talk about this a little bit later, but essentially the simplified explanation is the higher your credit score, the lower your cost of living. The lower your credit score, the higher your cost of living because there's more risk involved with you. So what has happened, unfortunately, was that certain servicers, Great Lakes was the big one, they serviced something like 8 million accounts. They were reporting people inaccurately to the different credit reporting agencies, and people were seeing their credit scores take a nosedive since the act went into law back in March. They're essentially reporting people as missing payments or in a deferment on their loans, thus impacting credit scores negatively. And the class action lawsuit that's been brought against all these, against the credit reporting agencies, because they should be aware of the CARES Act, and against the servicers is that, hey, you have done harm to the borrowers by wrongly reporting their CARES Act eligible loans. These are people that they're not required to make a payment, therefore it should not negatively impact them. It was even written into the law that you shall not do this. You shall not negatively impact the borrowers. And I get this question a lot. How do my loans or do my loans impact my credit score? Well, the answer is yes. They're an installment loan. As long as you're making payments on the loans, as long as they say paid in full, it doesn't matter how big the payment is, as long as you're making a payment on that loan, you're creating a history, thus impacting your credit score. If you say that you have 15 different federal loans, well, as long as you're making your payments, the reporting agencies are reporting, hey, you know, Joe or Jane Smith, they have made on-time payments on 15 different loans, credit score goes up. I've had people with, north of $500,000 of debt still qualify for mortgages simply because their credit scores were stellar. Now think about that the other way around. If all of a sudden you stop making payments on your loans, well, that would then be 15 payments that you just missed, credit score goes down. So in terms of what's happened with the CARES Act and credit reporting, it's really important that this be fixed because there's a lot of borrowers out there that were impacted not knowing. Now, if you're going for public service loan forgiveness, if you turn in your forms, your employer certification forms, your loan should be managed by Fed Loan Servicing, which is a different um, loan servicer. However, every loan servicer is kind of being scrutinized right now based on how are they reporting these payments. And of course, it's really important for people who might be finishing training. Sorry, might be finishing training because your next step could be okay. Well, there's the job applications. You have to rent your apartments when you leave. You might want to buy a home. Are you getting a car? All these things that revolve around your credit score. Well, what the servicers had done in the last 3 months affects everything that could happen as you transition away. So one thing to tell everybody on this webinar today would be, or tonight, I should say, I'm West Coast right now, so a few hours behind, would be check with your servicer. How have they been reporting your loans? Have they been reported accurately? If you do not have federal loans, then it's irrelevant. If you have SoFi, Link Capital, any of the other private lenders that you might have refinanced with, as long as you're making your payments, things are fine. However, for borrowers of federal loans, it's important that they reach out to their servicer and say, okay, hey, were you part of this issue? Yes or no? And if you were, was my account one of the accounts affected? So CARES Act. Now, consumer credit and debt. As a planner, I always look at how things are tied together. How do the dominoes fall when something happens? Credit is not just credit. You think about credit score, it's not just a number, it's a combination of different things. And how it affects a person in their household affects them in multiple different ways. You think about your credit score as a borrower, if you want to have your own private practice, if you want to take out a practice loan, if you want to become a partner. I mean, all these things that might include taking out debt, well, that's impacted by your credit. So, of course, when you think here, that the basics of when I'm thinking credit and debt, how does a bank make money? Well, banks make money off interest. You give the bank your money that they will then lend out to somebody. Hopefully, that person pays them back interest, thus keeping the cycle going. So think about this. This is, again, when you give your money to a bank or a credit union, that is the money, that is the collateral that they are using to lend out to other borrowers, other bankers at that same bank. So essentially your deposits, even though they are FDIC insured up to a limit, your deposits are still dependent on the credit worthiness of other borrowers that might be borrowing your money from that bank. So again, how does that interest work? How does the interest rate work? I'm sure all of you have had this lesson, but that interest is the cost of borrowing. If we bring up a calculator really quick, of course, planning, deal with loans, lots of calculators. But if you think here, your interest cost is this right here. As you change your interest rates, if you have a lower, I should say, credit score, the term of the loan doesn't change. It's still 10 years. The principal balance is still $100,000. The payment changes. Now it's higher. Your interest cost changes. It goes up. So this is that money that the bank is counting on. If you are considered to be a more of a higher or lower risk, I should say, higher credit score, lower risk borrower, the bank doesn't have as much risk in lending to you. Therefore, they don't charge you as much interest. Therefore, their revenue goes down. But that's your cost. If you look at it from your standpoint of, what is it that I feel on a monthly basis? You feel your payment. Well, your credit score has a direct impact on your monthly payment, on your cash flows. So banks go under when people don't make the payments and when consumers no longer deposit with them. So you think back to the financial crisis, this was a consumer driven crisis created by banks and their lending standards. They are not separate things that happen. I mean, I remember the financial crisis quite vividly as it was happening and in our office as these conversations were going on. And this is one thing that we worry about as planners as are we going to go back to this again today? Are you cycling back to where there's looser standards for lending? But essentially it was institutions were lending out money to subprime borrowers or borrowers who were less than credit worthy based on the values of these homes that they were essentially backing that loan. So of course the bank is thinking, well, if you don't make the mortgage payment, we'll just take the house. It's backed by a collateral asset. Well, when the home is not worth as much as was lent to the borrower to buy the home, now the banks take a bath because then not only did they not get the loan, did they not earn the interest, but then that asset that they owned was not worth as much as they thought it was. And then you think about the insurers of those loans. So again, we talk about um, asset-backed securities. Well, you would have these same institutions insuring their own loans with their own insurance products, thus perpetuating this collapse of sorts. Again, all from the fact that you had lenders lending money to people who could not afford to borrow. This changed, of course, a lot of lending standards, but when you really think about a loan, what is it? It's somebody else's money. Somebody else's money that they're willing to lend to you for the promise of pay based on your credit worthiness. And it's either somebody else's money or it's somebody else's goodwill. And when you think goodwill, you're thinking, of course, utilities. So the utility company is saying, hey, we'll let you use that utility as long as you promise to pay us back. I know, yeah, we can shut it off. However, it's still not cheap for us to shut off a utility. With credit, I mean, when you have revolving accounts, when you have mortgages, etc., is it something that they can grab back from you should you not pay? Or is it something that you actually, if you don't pay it, then what's the recourse? I mean, education is one of those non-collateralized debts. I mean, you can borrow for education, but there's nothing that they can take from you should you not pay. Yeah, they can ruin your credit score and they can make life difficult, but they can't take back your degree. They can't take back your training. So collateral, non-collateral debt. And everything, of course, is determined from your credit scores. Is that cycle? I mean, you have to get credit with a credit score, but if you don't have a credit score, how do you get credit? Like, how do you build that up over time? A lot of people they create their credit score from student loan borrowing. Is typically how my clients first started building their credit. They took out a student loan, they started making payments on a student loan, they started earning a credit score. That credit score, hopefully, as it goes up, their ability to borrow is a lot easier. Their credit rating is higher, therefore their cost of loans is less. Therefore, their cost of living is cheaper, allowing them more liquidity to then go out and do other things. So there's always that cycle of what is going on. So again, you can have two different people with the exact same incomes, but the person with the higher credit score has a lower cost of living because their interest rates are less, their insurance payments are less because insurance is tied to your credit score, than a person with that lower credit score. And I know we always talk about credit scores and what's good and what's bad. And here's basically my experience with it. Like your max is 850. 850 is as high as it gets. There is no real difference between a borrower's rate of interest for like a mortgage between a score of 740 and 850. And the conversations I would have with different banks as I would be creating other presentations or talking about business loans that a client might be taking out, et cetera, you'd always ask them, okay, well, hey, they have an 800 point, I mean, their credit score is 800. Can you shave off a little bit off that interest rate? Because look how good the credit is. They'll look at me and says, well, honestly, our bank doesn't look at anybody any differently once they hit 740 and above. So you think about a credit score, and when people ask me, okay, what is a good credit score? My opinion is 740 plus. If you hit 740, you're going to get the best rates that are available to you. When you get up above, when you get 850, if I've never met at 850, But a person with 850, no, they have 850. Their cost of borrowing is no less than yours. However, you can make the argument that a person with a score of 850 has more leeway in case something goes wrong. If they miss a payment on something, if something is improperly reported, they can lose 100 points and still be at a prime lending standard. Versus a person at 750, you can say, well, heck, if something goes wrong for them just for 10 or 15 points, all of a sudden now their cost of lending just went up, or their cost of borrowing, I should say, just went up. And so in your credit score, it's made up of your new credit, you have your balance. So when they look at your balance ratios, um, typically the issue I'll run in with a lot of residents would be, of course, the cost of moving to your new location or your cost of relocating to a new job. You would use a credit card and usually to pay for that, or they would use a residency relocation loan. When you overutilize that credit limit, when you say, okay, hey, if I'm able to borrow $5,000 and I've used $5,000, okay, well, you've used up the entire ratio, that negatively impacts you. Mix of credit, this is also really important. I've had people, as we'll see in the case study later on, where they just didn't want to borrow at all. No, I don't want to have a credit card. I don't want a credit card. Credit cards are bad. That's what I was taught. My family has never had a credit card. Okay, well, you have no credit history. Did you borrow a student loan? Well, yeah, I have a student loan. Okay, well, you have a student loan, you have installment debt, but do you have revolving debt? What other types of debts do you have? Payment history. How long is that history gone for? When people are in school, their loans are deferred. There's no history there of payment, there's just history of borrowing. Once they go into repayment, though, that's when their credit score starts either being positively or negatively impacted by the repayment. And that's how you can see people have, upwards of that that 800 point credit score, even as a resident with $400,000 of debt. Length of history. How long have you been a borrower for? So all these factors come into play. And it's important to always think about, okay, if I'm worried about my credit score, what is it that I do not have going on for me yet? Have I overutilized my credit card? Have I never borrowed something other than a student loan? Do I not have a really good mix of things? Have I only been borrowing, or have I only been in repayment for 2 years? I mean, what are the factors that are affecting your credit score that you could then work on to increase your credit score to go again, reduce your cost of borrowing? Of course, when I was mentioning earlier how mistakes can cost you points, well, here's the part where I was talking about going back to the CARES Act. People saying, well, this person's behind on a payment, how they're negatively or improperly reporting borrowers. Well, a 30-day late payment is a big hit against your credit score. Multiply that by multiple different loans, and it doesn't take very long for your credit score to take a dive. This is why I look at people in terms of, cash flow management and trying to create a timeline of things you have to do, just so that they will not miss a payment. So they will not miss recertifying their income. So they will not miss, a future payment that they have to account for. I mean, with the CARES Act, everything restarts again, I should say, in October. All right, well, I've met plenty of people who they get really busy during training, and they forget to even sign up for repayment after they graduated from school. All right, well, you think about what's going on in October, you probably just finished the onboarding process if you have found a new job. You were just licensed and credentialed. You're now about to start work. Who's to say what your call schedule might be? It's not hard to think that somebody might miss that start date of a payment in October. So again, keeping everything in mind and going, okay, how will that affect me? How will this part of my life affect me overall? And as we saw earlier, when I was showing the spreadsheet, interest rate adjustments have real economic impacts on a monthly basis. being that our lifeblood is our cash flow, what we bring in, it's important to always have as much cash flow available to us as possible. So right here, that 728.50, I would, if I can change the grid, I'll just show it 740, but 720 here. That's your best interest rate for this person. But notice how it's tripled for a person who wants to get down to that 500 level. All right, well, there's that thought about you as a consumer, but it could also be you as the business owner or you as a business partner. This score affects so many parts of life, both personally and professionally. Something to always keep in mind. Now, there are different reporting agencies that are out there that you hear about. You can go to annualcreditreport.com, pull up your credit history, your credit report. It doesn't give you your credit score, but it shows you everything that's underneath your social security number that has been reported. And I've had several instances where I'll either have a resident or a student go onto this site because something didn't look right. I had one student that they were denied the Grad Plus loans, their fourth year in medical school, which means they did not have money to finish medical school, all because something was misreported from a prior place that they used to live at. Fix that, fix the credit score, everything was fine. When people are going through major transitions in life, beginning residency, ending residency, buying a home, anything that you can consider major, always tell them, okay, hey, pull a credit report. Make sure you see everything that a bank would see. Anything on there, look out of place. Anything on there that you might need to fix. If the answer is yes, okay, great, let's fix that. Let's make sure that everything is reporting appropriately. Just like the people I deal with right now with the CARES Act, I'm telling all the people I work with, all right, hey, I want everyone to pull a credit report, please. Let's see how they are reporting your loans. It's free to do. You can pull one for each corporation every year. So every 4 months, you can go on there and pull a report, and you can cover the entire year for free. Yeah, it's tedious. Yes, it can be a little time consuming. At the same time, if you're getting ready for a major transition, it's important to be prepared for anything that might keep you from moving forward. I know plenty of people that the first thing they want to do after they finish training is, hey, I want to get ready to buy a house. All right, well, let's start that conversation now. What do we need to prepare for? So building credit, as I was mentioning earlier, you have 3 different types of credit. You have the installment, revolving, and open. And installment, just like it says, you have an equal monthly payment that you must make. Revolving, that's your credit card. Open credit is utilities. Those are the 3 main types. And if you look at your situation, go, you know what? I have a car loan, I have credit card, and I'm definitely paying for utilities. Well, your credit mix is all there. I mean, everything's right there. But when people ask me, okay, how can I increase my credit score? I mean, I'd always tell them, all right, well, what types of debt do you have? What's your history of making payments? Don't expect your score to jump right away. I know there are, oh gosh, I'm going to mess up the name on this, but something like Renter Karma or something like that. I'm sorry, I can't remember the name off the top of my head. And then you have like the Experian Booster or other services where they say, hey, we will increase your credit score. What they're talking about is saying, hey, we will utilize your rent payments that you make on your rental property. If you're renting an apartment, we'll report that to a credit reporting agency. Maybe that will boost your credit score. Also, if you have different companies like your Verizon or Sprint or other utilities that might not be reporting, what essentially is they're doing is they're saying, hey, let's increase the number of lines of credit that we are reporting to these agencies to show that, hey, yeah, you're a good borrower. Like, oh my gosh, yeah, we can boost your score some of the times. But that's essentially what they're doing. They're taking other payments that you might have going on that might not otherwise be being reported, and they just report them for you. Sometimes it works, sometimes it doesn't. This is why they say, hey, your credit score boost might change, but that's another way of building credit would be to use one of those reporting services. So we already covered types of loans. I mean, they're pretty basic that are out there. You're not going to get into a lot of intricate borrowing or intricate loans during your careers, unless you're looking at, of course, a practice loan or a loan to purchase ownership of a practice. That is a little different in terms of the business and the business entity and how that business entity will then be borrowing. But again, when you look at the types of loans that are out there, your installment, your secured, unsecured, revolving. We talk about secured. Again, there's collateral attached to it. You can have prepaid credit cards that you essentially you borrowing your own money from yourself, but yet it's being reported. That can be considered another secured type of loan. So here's a case study really quick. When we talk about all these things kind of tying together, I worked with a couple that on paper, they looked like they had the best situation possible. MD, PhD, never had to borrow from medical school, received stipends. Both of them did, therefore they were able to save one of their stipends for 8 years. At graduation, they had $100,000 saved up. They matched to New Mexico, University of New Mexico, and they thought, hey, we have no debt. They had never, ever, ever taken out a credit card. They had never borrowed for a car. They essentially, on paper, they looked like they were perfect in terms of assets to liabilities. $100,000 of assets, no liabilities. However, because they had no history, they could not get a mortgage. And this is where some people, they kind of take a step back and go, how is that possible? $100,000 of assets on hand, easily put down 20% on a home loan in Albuquerque. Why couldn't they get a mortgage? And it was this case study that kind of changed how I would counsel students as it would start up medical school. I always tell them, hey, do you have a credit card? It might sound strange, but get a credit card now. I don't care if you don't use it, just I need you to have that. You have to start building some sort of credit history for you. Because this is one thing about credit, is that a bank, they're taking a risk. They're giving you hundreds of thousands of dollars based on your promise to pay them back. Well, if they have no record of you ever paying somebody back, yeah, you might have $100,000, but for all we know, you might not have really good management skills, and this can be a risk that we don't want to take. They also had to put down essentially 6 months worth of a down payment on their rental. So they were staying at Airbnb, and then when they finally got a rental, they had to put down 6 months, I believe it was, just because they had no history in that rental company. It was like, hey, we pulled your credit report. There's nothing on there. Like, do you people actually exist? It's the strangest thing to think about, especially when you think about two medical professionals, no debt, a lot of assets, but no history. So history is really important. And so when you think about credit, they're looking at the character. They're looking at, okay, what is your credit history? All right, they had no credit history, nothing there. What is your capacity to repay? All right, well, they have an income, that's great. So we have one of those things, but we still don't know who we're borrowing to. What's the collateral? All right, well, the collateral is the house. Do we think we can get our money out of that house in case we have to repossess it? What are the external market conditions like? I mean, if COVID-19, the credit markets are actually pretty tight. A lot of people aren't going out there and getting private loans because, all right, well, how is your job impacted by what's going on right now? You think about credit right now, you hear about banks and lending, and you hear about people worrying about the financial institution. Well, you'd have a lot of people that they would take out business loans to pay payroll. All right, well, we don't want to give out a business loan for your payroll if we don't think you're going to be working, earning revenue to pay us back. Again, why they have these emergency forgivable loans out there. They're out there to actually help people make these payments in some cases. They really are kind of propping up the banks in a roundabout way. Of course, you already mentioned this. You talk about buying that home, getting that extra service. It really affects a lot of different things. And what you get into, though, is because it plays into so many different parts of life, you get into leverage. And this is where people start getting into trouble. You are a great borrower or borrowing prospect. You have, oh, hang on. Should I pay utilities using a credit card? I apologize, I didn't get to this question until now. It's where my eyes are diverted. Um, all right, great question. So, yes, I do tell people to pay your utilities, everything with a credit card. Utilities don't report, the credit card does report. Also, as you pay off that credit card hopefully has points that you can then use to do other things with. So I love credit cards that either give you cash back, they give you miles, or they give you points for purchases like Amazon gift cards, etc. But I would definitely use that credit card to pay the utilities just to build that history, just like you're saying in your question, you're saying you don't have a credit history because you are international. However, that's how you would build that up. They're not going to report you from the utilities, but they will report through the credit card. So utilization. All right. So the idea would be you would utilize your credit card, pay it off in full the next month. You don't want to carry the balance on the credit card. So you use it, pay it off, use it, pay it off. That's what they're looking at. So utilization, if the utilization is very minimal, but the payment history is there, then you're building positive credit. You would then use that positive credit to go out, either lease a vehicle or to buy a vehicle. Now you have revolving credit and installment credit going on at the same time, thus building out your credit history quicker because you have multiple different lines of credit. So that's a really good question. And yeah, I would definitely use it to use your credit card to pay your utilities. In fact, again, because you're using somebody else's money, if your credit card gets stolen, you can turn that off. You're not liable for that money at that point as you reported it, get the replacement card and continue on with life. So I always like kind of the protections that are offered through a credit card. So kind of getting back to leverage, I apologize, I didn't get that question until now. This is where people will come back and they'll say, all right, hey, I have a really good credit score. I have a really good income. Investment properties are fantastic. That's what I read about all the time. Investment properties, you should invest in property, etc. I'm going to leverage my income to purchase properties and use the income from those properties and leverage that to purchase more properties, et cetera, et cetera, et cetera. You're leveraging your income. Of course, with leverage, too much leverage, and all of a sudden things break, and a tidal wave essentially happens. We're we're dealing with one individual who they owned, I think it was like 7 or 8 different properties in the Portland metro area, Portland, Oregon. And when the financial crisis hit, their renters were losing their jobs, weren't able to make their payments on their home, on their rent. Because those rent payments were being missed, our client wasn't able to make their mortgage payments. Because their mortgage payments were being missed, they had to try and get out from underneath their homes by trying to sell them. They couldn't sell them, but for at a loss. Therefore, it just started cascading down. They over leveraged. According to the bank, this person was stellar. Yeah, they were stellar. They had all their ducks in a row. However, they essentially gambled their financial future on the ability of all the renters, their ability of the renters to pay. And so when people look at, how is it that I qualify for a mortgage or for any other type of debt? Usually a bank or institution will do what is known as a debt service ratio. What are your monthly debt payments? What is your gross monthly income? All right. So essentially what they're doing is they're saying, okay, let's get to let's say you make 150 just as a number. Say that's your gross monthly income, 1250. All right, well, 1250 times 0.42 or 42%, your debt service ratio, we will lend up to $5,200. Like if all of your payments, your student loan payments, your mortgage payment, your car payment, all those can equal up to $5,200 a month. And we're okay with that because you're at 42%. However, we don't live off of a gross number. We live off a net number, net after tax, net after you put to retirement, net after everything has been deducted from your paycheck. And as you start taking into account all those different variables, your paychecks can get down to $8,200 or 82,000. I apologize. Now all of a sudden you're using more than 50% of your paycheck just for the home or just for these various debts. And so that's when people look at, you go to a bank and they'll tell you, okay, well, we'll let you borrow up to X million thousands of dollars. Like when I watch, actually, my wife loves watching, I'm guilty of watching them with her, all these home buying shows. All right, well, as a planner, I always cringe when I hear these people say, okay, well, the bank approved you for $500,000. You're going to go out there and buy a $500,000 home. Let's look at all this money we have in our budget. That's based off of a gross number. Essentially telling a person to leverage 42% of their gross income to purchase a property, hoping that nothing happens that would negatively impact their cash flows, thus putting that property at risk in the future for seizure. And this is something that I always stress, especially when I'm talking to people in medicine. It's always, a lot of people oversimplify the profession. I know I did before I started working in academia and actually started working around other people who went through the training. We started working with UME, GME, and then of course, faculty development, etc. Before I started working in academia, I oversimplified, of course, the medical profession. Oh my gosh, these people, they're physicians, everything's gonna be fine. No wonder why people want to lend to them, isn't it great? However, all the different factors that affect income, is it RVUs, WRVUs, if you have elective surgeries that are canceled because of things like COVID, what's going to go on if you over leverage? How does that impact you? So I always tell people, all right, my rule of 42 is your net income. Yeah, you might not be able to get as big of a house. You might not be able to get a more expensive vehicle. And I never look at a person and say, oh my gosh, you should never have bought that. The way I look at it is like, well, you're an adult. You know what the cost is going to be. Are you happy with where you're putting your money? Are you okay with the return or negative return on the investment of purchasing a expensive vehicle? Are you okay with, the cost of that home, given everything else going on in life? Because everyone's situation is different. It's easy to assume that a person is over leveraged when really they could be perfectly fine. My biggest thing is making sure that regardless of what a person does with their money, their debt is not going to get away with them or away from them. Is where, people say you become house poor. You want to own the house, you don't want the house to own you. And so as you go out there and you start borrowing, things always keep in mind, of course, is it a collateral loan? Is it a fixed rate loan? This is where people, you get into these variable interest rate loans, adjustable rate loans or adjustable rate mortgages, these ARMs, where the interest rate is really low for the first 5 years. Then all of a sudden it goes skyrocketing after that. This is where you have these adjustable rate mortgages where people got into trouble back into 2008 during the financial crisis because people were, they were sold that, hey, adjustable rate mortgages are really great. You just buy this home at this low interest rate, and guess what? You can flip it for 10% gain 5 years from now. I hear people say the same thing nowadays because there's been that recovery in the housing market, saying, well, hey, I buy this home right now. I'll sell it in 5 years as I leave my residency. I had a lot of residents that I would talk to that, depending on where they match to, they'll say, yeah, I'll just buy a home, get an adjustable rate mortgage, and then sell a house when I leave. I hope so. Again, I'm very risk adverse. We also have to look at where the underlying costs of that borrowing. Collateral, secured loan, non-secured loan. A secured loan is always going to have an asset attached to it. Non-secured loan is just like I was saying, it's like a student loan, nothing they can take from you. I love it when things are fixed, because when it's fixed, you can project out to the future and you can know exactly what you're walking into 5, 10, 15 years from now. If it's variable, no one is going to change. What is it attached to? Is it attached to the LIBOR? Is it attached to S&P? I mean, what are the different things? Is it attached, not S&P, I apologize. The federal treasury. What is it attached to? Even as you're looking at a practice loan, I'm going to buy into a practice. Oh, the practice I'm buying into, they do their own self-financing. Fantastic. What are the terms of that loan? I'm glad they're able to self-finance within their organization. What are those terms of the loan that they're lending to you? Same thing when you look at some of these state and federal loan repayment programs that are out there for people in primary care. You have like NHSC, they'll say, hey, we'll give you up to $50,000 tax-free if you come work in a qualifying health center. However, if you don't fulfill your commitment, the interest rate on this loan goes to 10%, and we want it paid off in 2 years. What are the terms? There's always a term attached to anything that somebody gives you. Payday loans, the only reason why I bring this one up and why I find this one to be relevant is when you have residents doing a transition to either a fellowship in a different city, or resident or fellow transitioning to a new position, of course, in a different city, to where they might not get paid right away. So they will take out a loan based on their future income. And this is where I have seen people get into trouble, to where they have borrowed from one of these, then they had to go actually to family to try and pay it off, because the interest rate was so high they weren't able to keep up even at a attending salary, because of course their student loan payments went up, and then they had their other costs of living that went up as well. I realize that I only have probably 2 or 3 stories associated with these, and I don't see it as a huge issue for people in medicine, but it's one of those things that it'd be like a last resource for anyone, if ever. I'll tell people to go after residency relocation loan beforehand. So I know we're running out of time here, but very quickly, again, with going back to the credit card. The idea about the credit card is you want to pay off that credit card in full every month. You don't want to utilize the balance on that. If you still have a credit card balance, you want to try and pay that off as soon as you possibly can, because those credit cards have 25 or 18% interest rates to them that are typically variable. If you keep a balance, that balance goes down to your utilization of that card. That utilization, if overutilized, will then negatively impact your credit score. Also, you only earn points when you actually pay it down. Federal and private loans, when it comes down to student loans, if you're looking at refinancing, always know that a refinanced loan, there's no going back. It's non-collateralized debt. It's essentially protected from bankruptcy. You need to understand the terms of that loan. Is there a prepayment penalty? Is there a cost to borrow? Is there a finance charge? Always go through all those numbers, because again, it might look great on paper that has a lower interest rate. However, the cost to borrow it can still be greater than keeping the federal loans. And right now, I'll tell everybody, well, heck, don't refinance anything at all until October, because you're not going to get 0%. Debt that never goes away. Relevant slide as well. You'll always owe taxes. You'll always owe child support. You'll always owe alimony. And student loan debts, there are cases now more within you'll see it in the judiciary, where judges have said, you know what, I don't see why student loan debt is impervious to discharge. I don't see why that can't be forgiven tax-free. Also, can we keep this in mind with student loans is that if you're on an income-driven repayment plan like pay as you earn, after you met your payment qualifications, or after you met that period of time for repayment, which is 20 years, after 20 years, your loans are discharged taxable. So actually, student loans can be discharged if you're on the right repayment plan for the longest, for the appropriate number of years, then your loans actually are discharged. In fact, with the student loans, depending on how your income goes, of course, the payments go with it. So student loans, yeah, but there should be an asterisk next to that because it depends on the situation. So as with anything, always look at where you are. Look at what you think might change in the future. Plan on how whatever it is you're going to borrow is going to affect you long term. Always tell people who are going to buy a home, okay, what are other expenses you might incur? I mean, do you have to worry about childcare in the future? What about how is your revenue generated from your work? How is it, can you afford it if you lose income for a certain period of time? What are the risks involved with owning that type of debt? Do you need to take out a life insurance policy, or do you need to have a disability insurance policy in case something goes wrong so you can make those payments? I mean, there is the cost of the debt, and then there is the cost of owning the debt, which can be multiple different things that just kind of domino together. But once you have all that kind of analyzed and planned out, then the borrowing can make sense and work for you long term. So we're at the end. I know that's a lot, some very basic, some not so much. The last workshop is going to be next week, July 1st. We're going to go over tools and setting goals. Thank you for being here tonight. And any questions at all? I'm going to move this down here so I'm not staring off into space. Give it a few more minutes and then I'll log off. So again, thank you, everybody. Oh, no questions up from my end. All right, perfect. Looks like we're good to go. All right, everybody. Hey, stay safe, stay healthy, enjoy the rest of your week. Hopefully where you're at, it's beautiful weather. So take care and see everybody again next week. Oh, yes, I'm sorry. Yes, it is recorded. Joanne, when will this be available? By tomorrow. Perfect. Thank you, Joanne. All right, everybody. Good night.